Hello everyone, welcome to today's webinar relating to capital budgeting, and this topic is relating to FNSACC501 unit, that is provide financial and business performance information. Okay, and this is one of the core unit in Diploma of Accounting, that is compulsory unit that you have to do. And of course, this unit is a part of advanced diploma, and if you are doing bookkeeping pathway and accounting pathway, then you will come across through this unit. Okay, my name is Ruchi Makkad and I will be the presenter for today's webinar. And if you have any other questions after this webinar or any other questions relating to your course, if you need any assistance from my side, just drop me a line on my email address at ruchi.makkad@opencolleges.edu.au, or alternatively send me a message through OpenSpace, that's your online portal. It's up to you that how you want to communicate your things to me. So you can send me an email or drop me a message. During this presentation, if you have any other questions, I will just show you that's a question panel where you can type your questions. Please feel free to write your comments, your questions, and I will read all the questions for everyone and I will reply here. Alternatively, you can do one more thing here. If you can't hear me, please let me know by typing a message, or you can click on raise hand button. So this is the button, you can see it here. Yeah, that's a button. Okay. Yep. Okay. So agenda for today's webinar is capital budgeting. Of course, I will start with the main concept first. Types of decisions in capital budgeting, that what type of decisions that you have to take. Techniques of capital budgeting. Techniques, you can say that criteria for capital budgeting, and the last and the most important thing is methods to calculate, for example, payback period, NPV, that is net present value, ARR and IRR. Look, there are so many methods to calculate these things. If you want, you can calculate it manually. If you want, you can calculate them online. There are lots of online links available. Just type on Google that, for example, calculate IRR online. You will get lots of links to calculate these things online. Another alternative is to calculate through using calculator. So today in my webinar, I'm going to show you calculation of this method through manual calculation with all the formulas. Okay. So let's start with capital budgeting. You know, in financial management, the most important function for a finance manager is not only the procurement of external funds, but also to make efficient and wise allocation of these funds. Allocation of funds means investment of funds in various assets. And this decision is known as investment decision. As I said before, the most important function is not only procurement of finance, rather the most important thing is to allocate this fund. To allocate the funds, that means you need to invest your finance in various assets. And the decision is known as investment decision, where you have to make choice whether you want to invest in short-term assets or long-term assets. So there are two investment decisions in front of you. Whether you would like to invest your money in short-term assets, that's called, we can say that in current assets, or whether you want to invest your money in long-term assets, that is fixed assets. Short-term decisions basically comes under working capital management, and long-term decisions known as long-term investment decision, of course, or capital budgeting decisions. So today I'm going to talk about capital budgeting, that is investment in long-term or fixed assets. Of course, a finance manager has to take these three decisions: financing, that is arrangement of all finance; investment, to invest this finance; and dividend. Finally, that person has to decide that how much dividend has to be distributed among shareholders and how much dividend they have to retain in the business. So today I will talk about investment decision, And in investment decision, particularly I'm going to talk about capital budgeting decision, that is decision relating to investment in fixed assets or long-term assets. So let's start with capital budgeting. In simple language, capital budgeting means a process where you decide whether you want to invest your money in that assets or not, whether you want to invest your money in particular machine in that project or not. So basically you need to decide that in which project, in which machinery, in which land, for example, you want to invest your money. Of course, capital budgeting decisions are very, very important for a company because they affect profitability of the firm. Because, all the profitability of company depends on long-term assets. So, of course, these decisions are very important because they affect profitability of the company. Another why they are very important, because these decisions are irreversible decisions. Irreversible means once taken are not easily reversible without heavy financial loss. For example, if you bought one plant or machine and now you're not happy with that machine, of course, so it will be very difficult for you to sell that machinery because now it's second hand, and of course you will bear some loss. That's why these decisions are irreversible, not easily reversible without any loss. Of course, huge amount of money is involved in these decisions because they are relating to long-term assets. Of course, they are risky decisions because capital investment proposals have different degree of risk. Especially they may fluctuate your profit of the business. That's why they are more risky. Another one is these decisions are very difficult to make because they require an assessment of future event. Because today I'm going to tell you that how we assess our future profits. And we know that future is uncertain and unpredictable. That's why it's very hard to take these decisions in present time. Okay. So that's a basic theoretical concept of capital budgeting. Another thing it's very important to know about what kind of capital budgeting decisions are. First of all, if I'm talking about accept-reject decision. Accept-reject decision means, for example, there is only one machine and you have to decide whether you want to buy it or not buy it. Sometimes we normally call these decisions are relating to independent project. So that machine is independent. You have to decide whether you want to buy it or not. So what company normally does here? So what company normally does? Company decide one rate of return, for example, predetermined rate of return. And we calculate rate of return earned from that machine. For example, profit from that machine. And then we compare whether the profit earned from, of course, the profit will going to be earned from this machine. We need to compare this profit with predetermined rate of return or with predetermined profit. If you think that you will earn more as compared to your plan, so you will accept that. But if you think that you won't be able to earn that much, then you can reject these decisions. So either accept or reject. It's simple. Mutually competitive decisions means there are, I will give you one example first. For example, there are two sides, X and Y, and you have to decide where you want to construct. For example, if you go for X, if you choose X or select X, automatically site Y will be rejected. So mutually competitive means these are related to proposals which compete with other projects, and in such a way that acceptance of one will automatically result in the rejection of others. Of course, if you're accepting X, that means you're rejecting Y. It's so simple, unless and until you have like excess money and you want to invest in both projects. However, mutually competitive means you have to go for one decision. Third one is not covered in your learner's guide and there is no cushion. However, priority order means in case where the firm has unlimited funds, however, they have explained this concept in capital rationing. So what does it mean? So if a company has unlimited funds, So all those independent projects are accepted which yield a higher rate of return as against predetermined rate. The same example that I gave you here. For example, now you have XYZ projects. For example, XYZ, everyone is giving you more return as compared to your predetermined return. So you can decide your priority, that how much money you want to invest in project X, how much money you want to invest in Y, and how much money you want to invest in Z. Because all three projects are good and all three projects are giving you more return as compared to predetermined rate. So these are kinds of capital budgeting decision. Today I will try to cover practical part more as compared to the theoretical one. That's why I'm very to the point in the theoretical concept. But if you need any further clarification, please let me know. Please type your questions in the question panel so that I can answer you. Another topic is techniques or criteria of capital budgeting. Or you can say that basically methods of capital budgeting, that how to calculate. Normally we follow two criteria. It's very important to know about that what's the difference between profits and cash flow. So one criteria is accounting profit criteria and another criteria is cash flow criteria. Accounting profit criteria we use only in one method, that is average rate of return. Normally people call it average or accounting, it's one and the same thing. So accounting rate of return or average is the same. So in this method we use accounting profit and in payback, net present value, internal rate of return, these three methods use cash flow criteria. I will explain you what's the difference between these two. So let's start with average, or you can say that accounting rate of return. Okay. As I said before, that you can call this method by average or accounting rate of return. This method is based on accounting profit, not on cash flows. Accounting profits means after tax, after depreciation, or after depreciation, after tax, you can say that. Profits means that you have subtracted all expenses, of course, including depreciation. And we know that we always subtract tax at the end. That means, so also expenses and you have subtracted tax. That's why you came to this term, that is profit. So make sure that whenever I use in this method, we always use profit. And profit means subtract all expenses, then subtract tax, and whatever is the remaining amount, that's your profit. So what is the formula to calculate ARR? There are actually two concepts again. You can calculate ARR on original investment or on average investment. Sometimes questions will ask you particularly that you have to calculate this on original. Of course, then you have to use this formula. And if, for example, there was nothing mentioned in the question, then I would advise you to use both methods, because if nothing is there, you can calculate through both methods. So let's start with ARR on original investment. And the formula is, we need to calculate average profits. Make sure that profits means after tax. And tax is the last thing that we subtract before coming to the profit picture. Make sure that profits after tax. And you have to consider average profits after tax. Divide by original cost of investment, multiply by 100 so that you can get your answer in percentage. ARR on average investment. Instead of original, everything is same. Instead of original, here I have used average investment. Now average investment, what does it mean? Let's look here. Average investment means original investment minus salvage value. Sorry, it should be plus. It should be plus. I need to change this. Yep, here we are. It should be plus, it's not minus. So So original investment plus salvage value divided by 2. And salvage value means scrap value, you can say that. Now, I didn't do anything. Here. So, average profits, and how we find average profits means total profit after tax divided by number of years, and you have to divide this concept by average investment. And average investment means original investment plus salvage value divided by 2. Now, if for example there are 2 projects given to you, of course you will select that project which will give you highest ARR. For example, there are 2 projects A and B, and you have to decide which one you have to go for. The project which is having highest ARR will be selected and another one will be rejected. But if there is any independent project, for example, my predetermined rate is 25%. I have planned that I will go for only those projects which will give me more than 25%. I have calculated ARR, for example, prospective ARR of my machine. And for example, if it will give you 30%, of course, it's more than your predetermined rate, then we will accept this. Otherwise, we will reject that. So for independent project, select those projects that have an ARR that exceeds your target rate of return, that is predetermined rate of return. The most important advantage of this method is it's very simple. Very simple. And another advantage is you are considering entire lifetime of your project. Entire lifetime means, look, average profits after tax, how have you calculated this one? Total profits, whatever you have calculated, for example, you have to divide by number of years. So you are considering all years. That's an advantage. But the negative point is time value of money is not considered. I haven't explained time value of money yet. I will explain you this concept in NPV method. But here make sure that this method is good in simple because it's very simple. You are considering all years. But negative point is you are not considering time value of money and you are dependent on profits. And profits may show you fake figures. However, you need to have a look at the cash flow side. So that's a disadvantage. Okay, I will show you my example sheet here. Here are a few examples that I have taken from your learner's guide. So look at first example number 1. Parchment Enterprises is considering an investment project that will cost 230,000. It has an economic life of 4 years with no expected scrap value. That's fine. Scrap value means salvage value. Depreciation will be charged at 40,000 each year. Tax rate is 30%. You have to calculate ARR on average cost. Look, original investment. That means company is considering an investment project that will cost 230,000. So 230,000 is your original investment. Of course, your project life is 4 years. It's just prediction. And depreciation 40,000 each year. And the tax rate has been given to you. Now look at this table that has been given to you. Cash inflows for number 1 year, number 2, number 3, and number 4 years. Operating cash outflows. Cash inflows and cash outflows means you haven't considered any known cash expense item yet. So that means depreciation you haven't subtracted yet. And depreciation, why I'm saying depreciation? Because depreciation is known cash expense. You know, depreciation means decreasing in the value of money. And you are keeping this money as, we can say that you're collecting this money so that after a number of years you can buy that asset. Basically, it's a known cash. You're not paying to someone else. So cash inflows means you haven't considered any depreciation yet. So how we will do this? Make sure that this is average rate of return method, that is ARR. We need to consider profits. Profits means First, you have to subtract all expenses, then you have to deduct tax, right? And after that, whatever profits will be, you have to consider that one. I have already calculated some things for you. Look here, the table, cash inflows, outflows. Of course, you will subtract outflows from inflows. Again, that's cash outflow. Cash means you haven't subtracted depreciation yet. If you look at the question, depreciation has been given to you 40,000 per year. So less depreciation. So now, whatever the figure comes here, that is 20, 40, 70 and 75. So now you have profits, but before tax. You haven't subtracted tax yet, because tax is the last thing that we have to subtract. And we know that tax rate has been given, that is 30%. So 30% of 20,000, that is 6, 12, 21, 22,500. And once you subtract 30% from this amount, you will get your profits. And in ARR method, we have to consider this profit. If you have pen and paper handy in front of you, please note down that in ARR method, we always considered profits. Profits means after depreciation, after tax. First, we need to subtract depreciation, of course, all expenses, including depreciation. Then we have to subtract tax. Okay. Now I'm using formula. We know that average investment means average profits. So first, we need to find out average profits. Look at the profits, 14,000, 28, 49, 52,500. So we need to find average. So 14 plus 28 plus 49 plus 52,500 divided by number of years. That is 1, 2, 3 and 4. So you will have average profits of 35,875. And question was asking you to calculate this on average investment. Why I have written minus here? Okay. Now, there is no salvage value given to you here. Extremely sorry. I don't know why I have mentioned 0 here. So original investment plus salvage value divided by 2. There is no salvage value given to you. So what do you have to do? Original investment, we know that is 230,000 plus 0. And of course, we have to divide by 2 here in this case. So that's the average investment. And if we use the formula, average profits, that is 35, this one, divided by average investment, multiplied by 100, it will give you ARR in percentage form. There is one more example. I will do this example in front of you here. Project, I have just considered ARR first. So this project DEF is a 3-year project. That means the life of your project is 3 years, which has an initial cost of 6 million, with depreciation of 2 million, and scrap value at the end of the project is nil. That's good. Average cost of capital is 9%. The net profit after tax is expected to be. Look here, average cost of capital given. Anyways, we need not to use this term now, because if you remember, our formula is for ARR. We need to calculate average profits first. Average profit divided by, because the question is asking you an original cost. So average profits divided by original cost multiplied by 100. Divided by original cost multiplied by 100. Okay. So average profit, 2 million, 3 million, 4 million. 7 plus 2, 9. 9 divided by 3. That is, average profit will be 3 million. Okay. Original investment, it has been given to you. The company initial cost is 6 million. So original investment has been given to you. That is 6 million. Now you need to use formula for ARR, that is 3 million. I'm just writing M here, divided by 6 million, multiplied by 100. So it will give you ARR. Make sure that if you look at this question, sometimes some information has been given to create confusion. Look at this question. Depreciation has been given to you. However, if you read this information, net profit after tax. If I'm telling you that's net profit after tax means, so first of all, it's net profit. Net profit after tax. That means you have already subtracted all expenses, including depreciation. That's why you have subtracted tax, and that's why you came to these figures. So that's why, and in ARR method, we always consider after depreciation after tax. That's why I have ignored depreciation in this equation. I haven't used because there is no use. Already tax, like after tax figure is given to you, so you need not to use depreciation here. Any questions so far after that for ARR method? There is one question here from Maggie. How do you know how much a company can invest? Definitely, in the question, of course, it will be given to you this situation. Look at this one. Company initial cost. Initial cost means that's investment. So whatever the cost is, that is called your original investment. Investment means how much you are spending on this amount, this project. Any questions so far regarding ARR method? Otherwise, I will proceed further with payback. Yes, I haven't calculated this answer, but of course it will be 50%. 3 divided by 6 into 100. Okay. Any other question? And there is one more information given to you because I have copied this question where the question was asking to calculate payback, to calculate NPV. That's why all this information came. But look at cost of capital. So far, I haven't talked anything about cost of capital, so you can ignore this information. Of course, I will let you know that what does it mean. But so far, there is no need for this cost of capital concept. We got one question here that why I have multiplied by 100 so that I can get the answer, so that I can get my answer in percentage. That's why I have multiplied by 100. If you don't want, you don't have to. But again, in your answer, in percentage, it gives you more clarity. That's why I always prefer to use 100. Okay. I don't have any other questions regarding this method, so I'm moving further for payback method. So that's payback period. Payback period, another method. First of all, in this method, this is the simplest one. Payback is the simplest among everyone. And this is the most widely employed traditional method to calculate capital investment decision. This is one of the traditional method. So what does it mean? Payback period method means this method calculates number of years required to pay back the original to pay back the original investment in a project. That how many years will it take to pay back the original investment? Or this is the period which is required to recover the original investment in a project. I will give you one example to give you the meaning, that will tell you the meaning of this concept. For example, if a project or if a machine is having $60,000, the value is 60,000, and for example, you are expecting a cash inflow, like when you buy this machine, when you start using this machine, there will be some inflows in your business. For example, 12,000. Every year you will get 12,000 from using that machine. Look, in this example, you are spending 60,000. Of course, you're spending at present, and you are planning that it's your plan that annual cash inflow will be 12,000. So in how many years will you get 60,000 back? 12,000 per year, right? 12, 12, 12. So in 5 years, you will get your original investment back. And after that, all your profits. So payback period means the number of years required to pay back the original investment. That was a simple example. If cash inflows, if there was equal cash inflows, you can easily calculate. I will ask you one simple example here. For example, you're buying a machine for $80,000, and you're expecting a return, for example, of $15,000 per year. That is your cash inflow. So what will be the payback period? This is a question for you. Machine price is 80,000 and you are expecting a return of 15,000 every year. So what will be the payback period? Any ideas? Anything you can type on your question panel. Machine price is 80,000 and you are expecting a return, annual return of 15,000. So how many years will it take? Simply you need to divide, look here, 80,000 divided by 15, you will get 5.33 years. So 5 years plus whatever the fraction amount is in month. You are absolutely right, guys. So that's how we calculate payback period method. Of course, in payback period method, the project that will give you less payback period, that will give you quick returns, you will accept that one. For example, you have two projects A and B. For A machine, payback period is 3 years, and for B machine, payback period is just 2 years. Of course, I will go for B machine, so that in 2 years, I will get my original investment back, and after that, all profit. So the project which is having less payback period as compared to your predetermined, you will accept that thing. Okay. Now, there is one more method. I give you very simple method of equal cash inflows. For example, I give you like 80,000 and 15,000 each year. 15,000 was equal cash inflows. But what about if you will having unequal cash inflows? Then I will show you one example here, that in that case, how will we calculate that payback period method? Look at this example now. A project requires initial outlay. Initial outlay means your original investment. Okay. The project requires 80,000 of initial outlay and is expected to generate cash flows after tax but before depreciation. One thing that I want to clear here, please write down, for ARR method, we always considered profits after depreciation, after tax. But for payback period method, we always consider cash flows. Now, what does cash flow means? Cash flow means, please note down this thing, after tax but before depreciation. Now, cash flow, of course, it's a difference between inflows and outflow, but here what you have to consider, after tax but before depreciation. Because cash, if I'm using word cash, I should not subtract depreciation, because depreciation is known cash expense. Okay, so make sure that for pay, of course, I will give you some more examples here that how to calculate cash flows figure. Of course, in all the methods from now, that is payback, NPV, there is one more method, IRR, profitability index. Everywhere we use cash flows, and cash flows means cash flows after tax before depreciation. I have written this short term here. So it's already given to you. So now at this stage, you need not to be worried. In another method, I will show you if that information is not given to you. So 8,000, 20,000, that is your year 1, 8, 20, 14,000, 30,000, 32, 45. Look, this time we have unequal, sorry. Sorry guys. So this time we have unequal cash inflows. So if you have unequal cash inflows, step number 1, you have to find out cumulative. Cumulative cash flows after tax before depreciation. Cumulative means, look here. So year 1 is same, that is 8,000. But in year 2, you have to cumulate cash inflows with year 1. That is 8 plus 20,000. To one thing, I will use annotation if I can. Okay. So 8 plus 20,000, that is 28,000. So 28 plus 14, that is 42. 42 plus 30, that is 72. 72 plus 32, 104. 104 plus 45, 149. So if I'm talking about payback period method, and I'm talking about if cash inflows are unequal given to you, step number 1, you have to find out cumulative cash flows after tax before depreciation. So first, find cumulative one. Okay, now step number 2, what was your original investment or your outlay? That was 80,000. Just look at this cumulative figure now. What do you think? Like, how long will it take? How long minimum will it take to cover 80,000? First year 80, then 28 altogether. In year 3, I will be having 42. In year 4, I will be having 72 altogether. Look, which figure is less than 80,000? Just closest to 80,000, you can say that. Of course, these 3 are less, but closest to 80 is 72. So what I can see here, of course, that 80,000 is covering between year 4 and year 5. Because in 4 years, you will be getting 72. In year 5, you will be getting 104. So 80,000 will be covering between 4 and 5. So what is the formula now? Of course, definitely you have to come up to 4 years. Yes, 4 plus, if you have already covered 72, how much is the left? Of course, 8,000 is the left. And you need to divide 8,000 by your annual cash inflows of year 5. That is 32,000. So 4 years plus 0.25. I'm explaining you one more time here that how I came to that figure. First of all, 80,000. What is the closest figure to 80,000? I can see that in year 4, 72 is the closest. So definitely 4 years you have to come up to here. Plus, how much is remaining now? 8,000 divided by next year annual cash flow. That is 32,000. So here you will get 4 plus 2, 5 years. So payback period will be a fraction more than 4 years. You can say that. That is 4 years plus 2, 5. Any questions so far regarding payback period method? Up to here, that how we calculate cumulative and how we find this method. Any questions so far? Otherwise, I want to proceed further because NPV and IR are time-consuming ones. If you're happy with everything, please type yes so that I can proceed further with NPV method. Yep, all good. Thanks, guys. Okay, now let's move to another one, NPV. Just give me 1 minute. For payback period, I think I have explained you the most important advantage is it's very simple. Of course, this method is considering payback period. Payback period, NPV, if these methods are considering cash flows. And cash flow concept is very good concept as compared to profitability because cash flow will give you clear picture, especially for the firms who they are suffering from cash shortage. So it's important for those companies to consider cash flows instead of profit. Because in profit, you might have sometimes you follow accrued things, accrued revenues, but cash flow means how much exactly cash you have. Okay. So now I'm starting NPV method, that is net present value method. Just one more thing, sorry, regarding payback period. Of course, positive point is cash flow has been considered, but negative point is time value of money hasn't been considered in payback period method. So now, one of the serious limitation of ARR and payback period is that they don't take into consideration time value of money. That's one of the serious limitation of ARR and payback period method. Existence of interest provides money with its time value. Read these lines first, that what does time value of money means. Time value of money is the idea that money available at the present time is worth more than the same amount in future due to its potential earning capacity. This core principle of finance holds that provided money can earn interest, any amount of money is worth more the sooner it is received. Okay. I will give you one simple example first. For example, last year, I have saved $20,000. And this year, for example, I have saved $20,000 again. You know which year is the more beneficial? Year 1 or year 2? Someone can say that you're saving same amount, so both are equal. No. In last year, I have saved 20,000. For example, if interest rate in the market is 10%, for example, think about it. Last year, I have saved 20,000. What about if I have saved that money in bank and earned that interest? Of course, you have saved that amount 1 year ago. And now it's present time, right? Of course, money value always decreases. Just because of interest factor, if you have saved that money in bank or anywhere, and if you have interest, if you have earned interest in that money, that's why the last line is, any amount of money is worth more the sooner it is received. And the reason is just because of interest. This is very, very important concept here. The reason for more value of a dollar today than a dollar of future is just interest. I will give you one more example here. For example, someone gives you $1 today and another person gives you $1 after 1 year. Actually, the other person who is actually giving you 0.91 of today. I'm repeating this example again. For example, someone is giving you $1 today and another person, that is for example A, is giving you $1 today and person B will give you $1 after 1 year. Again, it's not the same. $1 you have received, for example, today you are receiving, and another person will give you after 1 year. Of course, what about in 1 year? There are lots of things happening in 1 year. Actually, the other person, that is B, is actually giving me 0.91 of today. If there is 10% rate of interest. How I have calculated 0.91, I will show you. Look here. One, how we can calculate present value factor. So the present value of $1 to be received after 1 year. How we can calculate present value of this $1 after 1 year? 1 divided by 1 plus R. R means interest rate. R is cost of capital. That is, for example, 10% in this case. And power 1. If you calculate this thing, I will show you. If you calculate this thing, 1 divided by 1 plus 10% power 1, it will give you 0.91. So this is how I came to this figure, that if that person will give me $1 after 1 year, the value will be not $1. The value will be 0.91. I will start with something, and after 2 years, again you can calculate exactly the same way. You just need to change the power, that is 2, after 3 years 3, and so on. I will give you one example first. So how we can calculate net present value method? Net present value is the present value of cash inflows minus present value of cash outflows. Present value of cash inflows. First of all, I will give you all cash inflows. You need to find their present value. And how we can find their present value? We need to multiply cash inflows with present value factor. If you want, you can calculate present value factor manually by this, but I won't recommend you to calculate manually this factor. It has already been calculated. Tables are there in your additional resources. I will share the table today with you. So you just need to look at the table if you don't want to calculate manually. The present value factor. Again, make sure that if there is independent project and you need to choose whether you want it or not. And simple criteria for that one is, if that project will give you positive NPV. Positive NPV means if your cash inflows will be more than compared to outflow, you will accept that, otherwise you will reject that. And if there are 2 or 3 projects where you have to decide, so the project will give you highest NPV should be accepted. There is one information given to you. However, you won't understand at this stage, but I will read it for you and I will explain you later. If there is any salvage value given in the question, it is added in the cash inflows in last year. I will explain you with the practical example. Okay. That's my example sheet. So first of all, net present value means cash inflows. Cash inflows means after tax but before depreciation. Now please listen to me this concept very carefully. First of all, for example, cash outflows have been given to you. Cash inflows have been given to you. So outflow, for example, inflow minus outflow, you will find out net operating cash flow. If I'm saying that cash flow, of course, this is net operating cash flow. Why I'm using cash? Because depreciation hasn't been subtracted yet. And you know, we can't calculate tax unless and until we have to subtract all expenses first. So make sure that you need to subtract depreciation first in order to get this figure, so that you can calculate your tax, that is 30%. I'm repeating the same thing. You can't calculate tax. Give me 1 minute. Just 1 minute, I just need to check the power cable. Yep, okay. Okay, so I was trying to explain you that thing. You can't calculate tax until and unless you have subtracted all expenses. So first, all cash incomes and all cash expenses here. You will get to know net operating cash flow. Then you have to subtract depreciation. You have to, because otherwise you can't calculate tax. So this figure will give you after tax, after depreciation. But if you remember, in payback period, in NPV and IRR, we consider after tax but before depreciation. So how we will come to that figure? It's exactly the same question that I have done it before. So 230,000 is outflow. That is your cost of that project. Life is 4 years. Depreciation is 40,000 each year. So what you will do in this case, you will subtract depreciation 40,000, then you will calculate tax. So that is after tax, after depreciation. But now we need figure after tax, before depreciation. What I will do, I will add depreciation in this figure again. Look, 14, 28, 49, 52,500. I'm adding depreciation again in this all year and I will get this figure. And this figure is known as cash inflows, that is after tax and before depreciation. Look, I always follow the same concept and I never get any wrong answer. Of course, it depends on the PV factor, that is present value factor, that how many decimals you are taking. But if you're using this concept, it's up to you which concept you want to follow. In your learner's guide, there is another method given to you that how to calculate NPV. But I always follow this method. I always get the right answer. And it's easy to remember. You just need to calculate after tax, after depreciation first. And you need to add depreciation again in order to get after tax, before depreciation figure. Okay. So years have been given to you. Cash inflows, that is 54, 68, 89, 90,000, 2,500. But in net present value method, the formula is, if you remember, present value of cash inflows minus present value of cash outflows. So first I need to find out present value of cash inflows. Look, this is all prediction. These decisions, of course, based on prediction. So after, for example, in first year, you will earn 54,000. That is your prediction. In second year, you will earn 68, and in third and in fourth. But again, if you think about time value of money, you are just predicting that after 1 year, you are going to earn 54. But have you considered interest factor? What about if cost of capital is 10% given to you, that is interest is 10% given to you, you need to write first of all present value factor. You need to multiply these cash inflows with present value factor in order to find out present value of cash inflows. The real value of $54,000 will be after 1 year will be 49,000. The real value of 68,000 after 2 years is 56. So this is how we calculate present value of cash inflows. I have just multiplied these two columns so that I had this figure, that is present value of cash inflows. And what I did, I have just added all inflows together, and that's my total present value of cash inflows. Now I will show you that how I came with this discounting factor. If you want, you can calculate it manually, that I have shown you in PowerPoint slides. Look here, like this, that R is 10%, you can calculate it manually, but there is no use to calculate manually. That is your PVF table. Look at the interest rate, that is 10%. These are the periods, means year. 1, 2, 3, 4, 5, whatever years, like depends on the question to question. In this year, 4 years or 5 years have been given to you. Just take the contents like present value factor from this table and you can use it directly. So formula is present value of cash inflow minus present value of cash outflow. Look, if you are buying this machine, think about it, the machine price is 230,000. That means you are spending this money at present time, right? And at present, dollar value is dollar. After 1 year, of course, it's not the same, but at present it's 1. That's why I haven't changed present value of cash outflow. Present value of cash outflow will remain same. If you want, you can show it by, because it's a present time, you can multiply by 1, it's the same thing. Because you are spending this money at present time. That's why I have used the same figure, and that's my NPV positive, so I will take this decision. So that's NPV method. Any questions so far? Any questions regarding NPV method? Yes, Lalita, definitely these, of course, not exact the same table because I have just copied from somewhere else, but definitely there are some tables under the additional resources. If you can't find it, please let me know. I'm more than happy to forward it to you, and I will let system team to fix that additional resources. Any other questions, guys, regarding NPV method, please? Otherwise, please type yes, because I want to proceed with IRR method. That's having lots of calculation in that. Okay, cool. Okay. Let's move to IRR method. So IRR basically means internal rate of return. So internal rate of return means a rate, a discount rate, you can say that, where present value of cash inflow is equal to present value of cash outflow. So in this question, basically, you need to find out such a discount rate that on which rate we will be having break-even point. Break-even point means no profit, no loss. That means your present value of cash inflow is equal to present value of cash outflow. I have just used break-even point in general sense, not technical sense. So just the meaning is a discount rate in which present value of cash inflow is equal to present value of cash outflow. In other words, a rate where NPV will be 0. Because if inflows and outflows present value will be the same, and if you subtract present value of cash inflow minus present value of cash outflow, and if they are equal, of course, you will get 0 NPV. So sometimes in questions, they may ask you to calculate IRR rate. Of course, you will see lots of online link to calculate IRR. But as I said before, today I'm going to show you manual calculation of these methods. So how we calculate IRR method. So here is the formula. Lower discount rate, I will explain you each and every concept with you later. Lower discount rate plus NPV at lower divided by NPV at lower minus NPV at higher, and you need to multiply by difference in discount rates. Now, don't worry about the formula, of course. I will share these slides with you so that you can have it in front of you every time. Now, steps. You need to remember these steps. It's interesting. Of course, it's a tiring job to calculate manually, but it's very interesting, especially IRR method. Okay, step number 1. You need to calculate fake payback period method. Now, how we calculate fake payback period? Initial cash outflow divided by average cash inflow. Average cash inflows means total cash inflows divided by number of years. Make sure that cash inflows means after tax and before depreciation. So that's my step number 1. Step number 2, I need to locate this figure in the annuity table against the row of number of years. This will be my first discount rate. I will show you example first, otherwise you won't understand. Okay, let's have a look at this example now. In this example, Wong Limited is considering the purchase of a new packing machine at a cost of 60,000. So your outflow, your outlay, your original investment is 60,000. Machine is having life of 5 years, end of which is expected to have no value. That means no scrap value, no salvage value. Fine. The machine is expected to result in the following cost savings. Year 1, year 2, year 3, 4, 5. Machine will be depreciated at 20% using the primary cost method. I think, just give me a minute. Okay, 20. And the company pays tax at the rate of 30%. First of all, I'm showing you to calculate cash flows. We know that these are just savings, 16, 24, 30, 40,000. First of all, we know that we need to subtract depreciation. And depreciation, look, there are so many methods to calculate depreciation. And if no information is given in the question, you can use straight line method or prime cost. It's one and the same method. In simple language, just take the original cost, divide by number of years. 60 divided by 5, that is your depreciation 12,000. Or the question is asking you to calculate depreciation 20% using prime cost. Prime cost means whatever the cost is, that is 60,000, depreciation is just 20%. Of course, it's 12,000. So anyhow, the figures are same. So these are depreciation. First of all, we need to subtract depreciation from cost savings. So 16 minus 12, 4, 24 minus 12, 12, 30 minus 12, 18, 40 minus 12, 28. And then now we can calculate tax. Because for tax, you need to subtract everything first. Tax is 30%. So 30% of 4,000, 30% of 12, 18, and 28. So this is the tax table. Another one is profit after tax. 4,000 minus 1,200, that is 2,800. 12,000 minus 3,600. So here is the profit after tax. As you are aware that in NPV and payback period IRR, we always consider after tax before depreciation. But this is the figure after tax. How can I come that figure? You just need to add depreciation and you will have that figure. So what I will do, that's the depreciation column. I know that 12,000 every year. I will add 12,000 in every single year to get that figure. So this is how I have calculated cash inflows in this table. And after that, I have added total cash inflows. Step number 1, once you calculate cash inflows, you need to calculate fake payback period. And how we can calculate fake payback period? Initial cash outflow divided by average cash inflow. Average means Look here, the total cash inflows are 116,000 divided by number of years, that's your average. And original, look here, initial cash outflow means the price of that machine, that is 60,000. So 60,000 divided by average cash inflow, it gave you 8%. Look here, just give me 1 minute, please. 60,000 divided by 23200. I have missed one thing here. Sorry, the figure is 2.586. Now, that's your step number 1. So in step number 1, you just need to calculate fake payback period method. Step number 2. Now you have this rate 2.586. What you have to do, you have to look in the annuity table. I'm not talking about present value factor table. I'm talking about annuity table. Look at the rows here. Where is that? I'll show you here. So our our answer was 2.58. Look at in the rows, 2.58. I can see 2.4, 2.5, 58, 57, 2.6. So 2.577, of course, this is the closest figure I can see. I hope everyone can see that. What I did actually, I just located this fake payback period in the rows, and I found this figure here, the closest one, 2.57, under 8% rate. So here, so now you have calculated from A2 table, that is annuity table, you can say that, you have found that the rate is 8%. So now what you have to do, you need to calculate NPV at 8% first. Step number 2, you can say that, we need to calculate NPV at 8%. And we know that how to calculate NPV. All cash inflows have been given to you. Present value factor at 8%. Make sure that now you need to have a look at present value table, that is PVF table for 8%. That is 0.9259, 0.8573. So that's I have mentioned here. And how I will calculate present value of cash inflows? I need to multiply these two tables and you will get your total cash inflows. And the formula is present value of cash inflows minus present value of cash outflow. So here is first NPV. Now please listen to me very carefully here. If you get positive NPV, you need to find out another NPV with negative number and vice versa. That means if you get negative first, you need to have a look at for positive one. But here in this case, I already got positive. So I need to find another NPV with negative results. And how I can do that? Negative means this number should be lower than 60. Then I can get negative figure. Lower than 60 means, I will show you one thing. Look here, lower than 60. Lower than 60 means if I will if I will write lower number here, you will get, look here, you will get lower numbers here, so that you will have lower number than 60,000. Or you can remember by this, if you get positive NPV, go for higher discount rate so that your NPV will be negative. Higher discount rate means, because previously you have calculated at 8%, now your NPV is positive. So you need to go for higher rate. Of course, more than 8%, but make sure that your NPV will be negative. You can't believe that. I have just calculated this table 10 or 15 minutes ago, and I was trying to calculate because I need another NPV with negative figure. What I did, I was trying for 10%, 11, 12, of course, not for everyone, 15. Finally, I found at 25%, I got this figure lower than 60,000. So that's why I was telling you that this method is interesting, but it's time consuming. So here, same thing, but you need to find out another number. I was calculating again and again, like again the same NPV. So I have found one NPV at 25%, the negative number. Same, you need to write out cash inflow. You need to find out present value factor at 25%. That is PVF table. And again, you need to multiply these two columns to get present value of cash inflow. Look at this figure, again the same formula. Now this time you have negative NPV. That's what I was looking for. So now in this method, basically we have to look for two NPVs. One is positive and one is negative. Now if you look here, the formula is lower discount rate, that is 8% is the lower one. NPV at lower. NPV at lower was 30,688, that is 30,688 divided by NPV at lower minus NPV at higher. At higher, it was negative. That's why I have mentioned, because you have to put negative sign, and another figure was already negative. So negative plus negative, you can say that positive in mathematical sense. And you need to multiply by difference in discount rate. Difference in discount rate means 25 minus 8, that is 17. I have just solved this equation and this is my IRR. Now, if you will look at this steps, now you will understand. Look, step number 1, payback period, that is initial cash outflow divided by average cash inflows. Step number 2, locate the closest figure to fake payback period in the annuity table against the row of number of years. This rate will be your first discount rate. Step number 3, find NPV at this above rate. Now, if you are having positive NPV at this stage, that means you need another NPV with negative results. And how we can do that? Just remember this line. If NPV is positive, that means you need to go higher to get negative NPV, and vice versa. If your NPV is negative at this stage, you will go for lower rates to get positive NPV. And finally, at the end, you need to apply this formula. So this is how I have calculated manual calculation of IRR, NPV payback period method. Any questions so far? Any questions regarding any method? Thanks guys. I would advise you to do all practice activities. Again, please don't be confused when you see the solutions in your learner's guide, because they have used different concept. I have used whatever I know about capital budgeting. I always use this concept. That's why I have shared with you. So I would advise you to use this concept, and if you have any questions, get back to me so that I can advise you further. Definitely, once I finish this webinar, I will request my video team to have the YouTube link, and I will request them to give me the link by today so that I will share with you by today. Otherwise, definitely by tomorrow morning, you will have the slides and link from me. And if you didn't get that, please get back to me or check your spam. Otherwise, I normally send by next day. Normally, all the students get this thing. Any other questions so far, guys? Lucy, my email address is, which course you're doing, Lucy? Sorry, I'm just wondering which course you're doing. Diploma or? Otherwise, I will share my email address with you. That's not a problem. Oh, okay, bookkeeping. Just give me a minute. That's my email address. You can note down. Otherwise, you can send me a message through OpenSpace. Otherwise, you can send your question to your course trainer, that is Yushra, that is for bookkeeping. Just send your question or query to her and she will pass it to me. Anything convenient with you, that's not a problem with me. Any other questions, guys? No worries. Thanks, Yuko. Good. If you have learned something, that's definitely a good thing for us to know. And if you need any other session from this unit, please let me know. I'm more than happy to run any session. But of course, my concept will be different as compared to Learner's Guide. I would like to use manual calculations instead of online and instead of using calculator. However, it's totally up to you. There is no restriction, nothing which method you want to use. As long as you're getting the answer, that's it. We got one question here. Would it be possible to get the hard copy of your lectures sent via my email? Marina, what I normally do actually, once we finish the webinar, by next working day, you will get the YouTube link so that you can watch this recording anytime, whenever you want, and you can have examples, that file, all 2 tables plus this slide. So I will send these 4 documents with YouTube link. Any other questions from your side, guys? Otherwise, I need to close this webinar. How can I work out the power of 1 if I don't have a calculator that has a feature on it? Okay, then you have to calculate. That's why I told you. Otherwise, just use the table. Table is much convenient. Otherwise, you need to multiply the same thing. Like if it's 2, then you have to multiply by 2. If it's 3, you have to multiply by 3. Where is that? Here. Look. Power means, of course, that is 1 plus 10%, 1 plus 0.10. So 1.10, of course, 1 means you have just 1 this one time. 1.10 multiply by 1.10. You can calculate this manually if there is no power feature. Have a lovely evening, guys. And if you have any other questions, please feel free to contact me. I'm here to help you guys. Angela, you will receive email link, YouTube link from me. Or otherwise, I'm just wondering, because I always share the YouTube link and all the files of all the webinars, because I'm managing webinar project. I always share with all the registrants. Haven't you get from me previously? Or is it your first webinar? Sorry, I'm not sure about that. If it's your first, definitely you will get YouTube link from me. But otherwise, normally all the students get by next working day, they get everything. Oh, okay. No, don't worry, you will get everything from me. Otherwise, you have my email address. Just drop me a line. I will get back to you. Thanks, guys. And I'm just going to close this webinar. Any questions, please feel free to let me know. Thanks for attending for today's webinar. Thanks for your time.